And filling Merkel's shoes, the German Chancellor's coalition heads for a two-man showdown as Bavaria's leader throws his hat into the ring to succeed her. Welcome back to the programme, everybody. The second hour of the European market open. Just some 20 seconds to go until the start of the European equity trading session. And so here is what European equity market futures look like this hour. Fairly flat, essentially. We're coming off the back, as Mark was telling us last hour, of quite a negative session in the Asian equity markets. So down by 9/10ths of 1%. The Indian markets, the Chinese markets under quite considerable pressure. The Shanghai Composite down by more than 1%. COVID infection rates still very much part of the narrative in many parts of the emerging markets, and that certainly is perhaps having an impact on investor sentiment in those locations. Moving through into the European session, the psychology perhaps looks a little bit different. The at the margin narrative maybe looks a little bit different. We have the reopening story to talk about here in the UK, in England, and to some extent in Wales as well, specifically. We also have the better data coming out on vaccinations in Germany and perhaps also in France. So all of that adding up to something of a different narrative perhaps for European equity markets. But this is where we are then at the start of the European trading day. And we do see something fairly flat in Germany and in France. But the Spanish IBEX and the FTSE 100 MIB, both of those moving to the downside. So we do have some moves lower for some of the major markets. And in fact, when I look at the sector breakdown, all of the sectors seem to be in negative territory, apart from autos and auto parts, which perhaps is helping the German market. But elsewhere, we do see basic resources in particular, travel and leisure also moving to the downside. So European equity markets opening fairly mixed this morning, a little bit weaker, in fact, down by around 0.2 of 1% on the Stoxx 600 so far. Now, one of our top stories today is the reopening of retail and outdoor hospitality across England. After months of being shuttered, these businesses will open their doors to the public today, marking the second stage of the government's roadmap out of lockdown. But what will the UK retail landscape actually look like? For more, we're joined now by Emma Chandra, who is live on Oxford Street. Staying warm, Emma, on Oxford Street. I'm hearing reports of snow this morning from various parts of the country. How hard is the industry being hit then, or has it been hit by the lockdowns, and what excitement about the reopening today?
And yes, it is rather chilly here on Oxford Street, but we are trying to keep ourselves warm this morning. Certainly walking up and down and looking at the preparations for stores here to reopen this morning. The retail industry, one of the hardest hit during the pandemic, certainly in terms of job losses. Some 67,000 jobs in the retail sector lost net. That's according to the ONS. 17,500 chain store names have shuttered their doors. Also, the British Retail Consortium telling us the cost of the 3 lockdowns in England to British retail, some £30 billion. And certainly there are names that have gone to the wall during the pandemic and we will not see them reopen. I'm speaking of Arcadia Group. They used to have their flagship Topshop store just behind me at Oxford Circus. That will not reopen. The same for the likes of Debenhams. And I'm standing close as well to John Lewis, a stalwart of the British High Street, excited to reopen their flagship store this morning. But we know a third of their fleet will not open again after shutting their doors during the pandemic. Still, there is palpable excitement about the reopening. I've certainly seen a lot of emails, there's a lot of social media about stores getting ready to welcome customers back in with COVID secure measures. Of course, there'll still be mask wearing, plexiglass, social distance queues and lines. in stores, etc. But certainly excited because we are seeing the British public with some £150 billion in excess savings, and retailers really hoping that they will be willing to splash the cash. The concern, of course, is how sustained that will be, whether that will last beyond the excitement of the reopening and people rediscovering their newfound freedoms, or whether, of course, those online shopping habits built during the pandemic, whether they will endure, and what eventually that will mean for store-based retail. Anna.
Emma, thank you very much. Emma Chandra, she'll be reporting from Oxford Street all morning, snow or not, and she'll be back a little bit later on in programming for you. For a market perspective on all of this, let's talk to Valentin van Nieuwenhausen, NN Investment Partners CIO, who joins us this morning. Valentin, good to speak to you. So from an investment perspective, this partial reopening of the UK hospitality and retail sectors, clearly a very welcome sign for those watching the rollout of vaccines and indeed the economic story here for Europe. Is this all priced in, though, or is there still further to run in the undervaluation of UK assets that we hear about from some of our guests?
Well, first of all, it's great to see. I mean, we've got snow here as well, still in the Netherlands, but completely locked down still. And I think the positive energy that almost everybody, I think, feels when you see these images and hear these stories does carry a certain amount of weight also economically. So it's incredibly difficult to model that. So I would assume that markets have not fully priced the sort of impulse that can come from this for the economy. So in that sense, I do feel that the reopening now in the UK, probably later in towards summer in Europe, will provide quite a significant boost to the economy, and therefore probably gives the recovery and also the overall tone in markets another area of support.
Yes, I mean, the UK economy usually fairly cyclical, and perhaps that plays, the sector weighting, perhaps that plays in the UK's favour right now, maybe not this morning, where we see the FTSE 100 down by 0.4%. How would you expect UK equity markets to perform in relation to European peers, to global peers?
Well, I think the picture is relatively positive, of course, on the back of the vaccination program and the rollout, which has been so much more effective than in the rest of Europe. And indeed, it's a cyclical market generally. Of course, financials, certainly the more sort of traditional parts of banking, but also manufacturing export sectors will benefit from this. What is noteworthy, however, is that the UK market FTSE so far, although rising nicely this year, is lagging the European equity market. So there is an element there where maybe the currency plays a role. Sterling has strengthened a lot, so that is maybe a bit of a headwind compared to some of the other equity markets. But all in all, I think the outlook for UK assets is certainly good in this cyclical recovery background.
Just looking at the sector breakdown of what we're seeing this morning then, Valentin, and it's interesting to see that one of the only sectors, there's just two in positive territory now, technology and autos and parts. So one of those is autos, and that does seem to be supporting the German market a little bit this morning. How much further does that narrative have to run? How do you value those traditional, but not so traditional now, EV-focused German automakers compared to the newer entrants into that space?
Well, what is indeed very important is that if you talk about autos and if you talk about Germany specifically, there's a couple of other elements. But the transition, or at least the embracement of a transition into EV by German car makers, is something that is critical. That was not there really substantially maybe 1-2 years ago. That transition has really taken place. So in that sense, I think there is more to go there. They have amazingly strong brands, and if they're really willing to embrace this EV transition, we still see further upside for that part of the auto sector as well.
Let me ask you about another sector on the move this morning, Valentin, because I know you have thoughts on it. Your long materials, give me your thoughts on why so at this point. Basic Resources having a tough March, one of the worst months since September, I think, and Basic Resource stocks this morning, one of the three worst performing in Europe. Why do you think that you want to be long materials at this point?
Well, I think overall we're still looking at a global economy that is sort of plowing its way back to a much more normal level of activity, and we're seeing certain trends where also the let's say globalization trends and supply chains are a bit more disrupted than they were in the past. I think if you combine the two, there's going to be sort of a maybe not secular, but certainly for the next 1 or 2 years, very firm demand for overall materials we expect in a global economy. Certainly also with China growing as strong as it is and looking to remain quite resilient. So all in all, I think the macro factors remain quite supportive for materials. And there's some specific needs, of course, also related to whether it's semiconductors or other types of needs that need specific materials that will also continue to provide really strong demand there. So yes, in the short term it's a bit weakish, but we think that the medium term sort of macro factors are remaining quite supportive for the sector.
Okay, Valentin, stay with us. Valentin van Nieuwenhausen, NN Investment Partners CIO. He stays with us. Further thoughts from Valentin on the US growth story shortly. Just want to bring you some breaking news that we've got through from the utility sector over in France. We're hearing this morning that Veolia and Suez announced that they have reached a merger agreement. This has been a long time in the making. Veolia and Suez agree on a price of €20.50 a share of Suez, and we can see that the share price is spiking as a result. We're up by just over 7%, in fact. No, just over 6.5% or so on the Suez share price. If you look at the 3-day price, we're up some 7%, but just on the day, we're up by 6.8%, as you see on the screen. Coming up on the program, Jay Powell says the economy is at an inflection point, but COVID still remains a threat. More on the US in our next conversation. This is Bloomberg. Welcome back to the European Market Open. We're 12 minutes into a European trading session that looks fairly flat overall, but some real divergence between what we're seeing over in Germany and to some extent in France versus what we see in London. Let's take a look at some of the stocks that are on the move this morning. Bloomberg's Danny Berger joins us with a look at those. Danny.
Anna, the budget airlines are doing really poorly today. They're some of the biggest losers, EasyJet being one of them, but also Wizz Air, Ryanair, all falling today. It is a down day on markets, and it is these higher beta, more reopening, economically sensitive companies that are leading on the way down. So perhaps some virus concerns here and travel concerns after the new stoplight system unveiled by the UK. Now, in terms of looking at the other side, some of the biggest gainers, Diasorin is one of them, the Italian diagnostics company, surging today, trading higher by more than 7%. They're going to buy a U.S. diagnostic company. That key here, they're a big maker of COVID-19 test kits. Also just gives the Italian company more exposure in revenue from the U.S. Now, finally, the biggest will they, won't they M&A story of Europe, it really feels like for more than the past year, is Suez and Veolia. Finally, they've agreed to a merger. The price they're looking at is €20.50 for Suez, of Veolia making that purchase. Shares are climbing, not quite at that level yet, but still up 7%. Now, let's quickly get a look at the overall market. It is somewhat of a dull day, not necessarily any big overriding catalyst for that. You have U.S. 10-year yields able to more or less hold on to some of the gains they made on Friday after that higher inflation data. So perhaps some of the dull market attitude is that inflation concern. We're about to hit earnings season in the U.S. Things really priced to perfection with expectations high at this point. Also, just want to point out Bitcoin able to breach that $60,000 level ahead of Coinbase's IPO this week, Anna.
Danny, thanks very much. Danny Berger with the latest on the stocks that are on the move and indeed some of the macro themes we are keeping across this morning. Let's get a Bloomberg Business Flash. For that, here's Laura Wright.
Thanks, Anna. Microsoft is making a massive bet on healthcare artificial intelligence. The software giant is set to buy Nuance Communications. It's been collaborating with the firm since 2019 on tech to allow doctors to capture voice recordings and enter the data into electronic medical records. We're told if talks are successful, it could announce the deal as soon as today, and that would be Microsoft's biggest deal since it purchased LinkedIn. An Abu Dhabi sovereign wealth fund may invest in Saudi Aramco's oil pipelines. Mubadala is in talks with U.S. investors leading a consortium. Aramco has put together a loan of around $10.5 billion to fund the transaction. It's part of Saudi Arabia's drive to open up to more foreign investment. Grab's SPAC deal is putting Southeast Asian tech on the map. Sources tell us the ride-hailing firm will unveil a listing this week via a blank check company backed by T. Rowe Price and Temasek. The deal will value the firm at more than $34 billion. It could be the biggest SPAC merger ever. That's the Bloomberg Business Flash. Anna.
Thanks very much, Laura Wright here in London. Now, the US economy is at an inflection point. That is according to the Fed's chair, Jay Powell, who sees stronger growth and hiring ahead thanks to rising vaccinations and powerful policy support. But the pandemic remains a threat. He spoke to CBS's 60 Minutes.
What we're seeing now is really an economy that seems to be at an inflection point, and that's because of widespread vaccination and strong fiscal support, strong monetary policy support. We feel like we're at a place where the economy is about to start growing much more quickly and job creation coming in much more quickly. So the principal risk to our economy right now really is that the disease would spread again.
The thoughts of Fed Chair Jay Powell there, of course. Valentin van Nieuwenhuizen, NN Investment Partners CIO, is still with us. Valentin, it's going to be a big week on the inflation conversation this week. We're going to get inflation data out from the United States. And I was interested in some of the thoughts around inflation and what that does to stock valuations. How much further do you think stocks have to run when we think about the warning signs we're getting on inflation? I was reading one of my colleagues saying that warning signs around inflation are popping up like spring flowers right now.
Well, it's definitely been not only the talk of this week, but probably the talk of this year. And obviously, there is a breaking point, talking about inflection and breaking points, where inflation becomes a destabilizer for the economy and thereby a risk factor for equities. However, I do sort of tend to still feel some sympathy for, let's say, the Fed's perspective, in a sense that they're emphasizing a lot that, they're willing to look through it on a temporary basis. There's clearly, whether it's tax issues in Europe with the VAT, or whether it's the energy price impact, there's clearly temporary factors at play right now, which will drive up inflation numbers in the near term. And the big question is not so much the headline readings, but the big question is really, how do we look at that from a medium-term perspective, let's say on a 1 to 2 year horizon? A moderate increase in inflation is actually not a bad thing for corporates. It does allow stronger top-line growth. It does allow a bit more pricing power. It does create a bit of room to actually support your earnings dynamics. So I think we are not yet at this breaking point stage. I think at this point it's sort of rejuvenating overall the economy. It is part of the recovery story, and therefore certainly for the coming quarter and the earnings season, but also for the rest of the year, I don't see a big risk for earnings and for equities. However, if there is indeed an acceleration from the current pace, we will have a risk. We will have a problem.
Okay, that is interesting. So that is where the risk comes from then, in your view, Valentin.
Yeah.
Talking about the things that have got us into this place in the inflation conversation, the fiscal support, the monetary support has a lot of people asking, you know, when are we going to see inflation coming through? It also raises questions about what is priced into markets from the fiscal and monetary support that we're seeing. And I've been reading quite a bit about whether we've seen equity markets fully reflect the size and scale of the fiscal stimulus that is coming in the US. Maybe markets open to the positives, but not maybe digesting the negatives, higher tax rates, for example. Goldman Sachs saying that an increase in corporation tax could cut 9% of 2022 earnings in the United States. Do you think markets are aware enough, awake enough to the potential for higher taxes to reduce earnings?
Well, I do think that is one of the biggest risk factors out there now. Currently, of course, the plans are being designed how Biden is planning to sort of pay for all these expenditures, the old bill that has already passed Congress and a new one that he intends to push through. And of course, there's a lot of discussion as well, more globally, about taxation and harmonization and a minimum tax rate for corporations and all that. Europe seems to be open. The OECD is working on plans, but all these factors are not fully clear. At the same time, we have equity markets globally, in Europe, in the US, almost everywhere at record highs. So have they fully captured this? No, I don't think so. And is there, next to maybe a more general macro inflation risk, another risk factor for equities? Yes, that is related to the impact of corporate taxation, and that needs to be monitored very closely. There can be more macroeconomic benefits, but from a corporation's perspective, I think here's a risk for equity markets for sure.
Valentin, thank you very much. Valentin van Nieuwenhausen, NN Investment Partners CIO. Thanks very much for joining us here on Bloomberg TV. Valentin will be continuing his conversation with us on Bloomberg Radio. That's at 9 a.m. UK time. 20 minutes into our European trading day, coming up here on the European Market Open, throwing his hat into the ring. Bavaria's leader, Markus Söder, joins the race to succeed Angela Merkel as her coalition heads for a two-man showdown this week. We bring you all of the details from Berlin. We're live there next. This is Bloomberg.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Welcome back to the European market open, 23 minutes into our European trading day. European equity markets succumbing to the downside broadly, it seems. Even in Germany, where we saw those early gains for auto stocks, we are now negative, down by just 0.1% or so. Sticking with the German theme, Angela Merkel's Conservative bloc is heading for a two-man showdown over its candidate to succeed her as German Chancellor after the leader of Bavaria's ruling party threw his hat into the ring this weekend. Joining us now for more is Agatha Cantrell from Berlin. Aggie, very good to have you with us on the program then. So from Bavaria, we have a late hat thrown into the ring, but Bavaria, socially conservative Bavaria, does not usually provide a candidate for this particular political grouping. So where does this leave the CDU-CSU?
So as we see it now, the Bavarian option is very much more favored in the polls, especially when compared with the leaders of other parties like the Social Democrats and the Greens, which are their key rivals for September. But it is, as you say, typically the case that the leader for the bloc, when they run in the national elections, comes from the CDU, which represents 15 of the federal states as opposed to just Bavaria. And a lot of parallels have been made recently about the rivalry between Helmut Kohl, the famous Cold War Chancellor, and the CSU leader of his time, who was a clear rival for him to take it and was seen as there was a rupture in the party because of that. And so what was really made clear yesterday when Söder made his willingness to become Chancellor clear, when in that press conference with Laschet, both of them were making their interest in unity within the party important. And so this morning they're both having meetings with separately with their own parties to try and come to an amicable agreement in the next couple of days as to who will run for the bloc's Chancellor candidate.
Yeah, it was interesting to hear certainly Armin Laschet and talking about working together, whatever the outcome here. In terms of the fight against coronavirus in Germany then, Aggie, how are the prolonged measures to contain the virus impacting on the election campaign?
Well, the measures have continued for longer than a lot of people probably expected because of this interest in getting rid of the third wave of the virus, which is still hitting the country quite hard. But in the last week or so, we've seen a real ramp up in vaccinations, which could also be attributed to expanding the ways in which people can get vaccinated in the country. They can now get vaccinated at doctors' practices, for instance. And because of this, we can see that potentially the CDU may be able to maintain their lead, be it a smaller lead in the polls going into the September elections, when earlier in March it was showing that they could really be losing out to the Greens.
Aggie, thanks very much. Aggie Cantrell, live for us in Berlin. Coming up on the programme, we speak to the Trustly Group CEO as the fintech firm announces its IPO plans. That conversation coming up next on the European Market Open. This is Bloomberg.
know that Norway sells way more electric cars per capita than the US? Norway. Well, I won't stand for it.
In this neighborhood just outside Oslo, the majority of cars are electric. Last year, Norway became the first country in the world to sell more electric cars than any other. In December, EV market share was at 67%. In 2025, the country wants all cars sold to be zero emission.
Hey, Norway, listen up, you fish-loving... Oh, this place is adorable. Damn it.
But why is Norway leading this development? The country is rocky, it's ice cold, and with huge distances. The easy answer is politics. By giving the consumers benefits that pay off, more people will go electric when they're getting a new car. These perks could be no VAT when buying the car, reduced tolls, the possibility to drive in the bus lane, and quite a bit of free parking as well. 2021 is an election year in Norway, and the Climate and Environment Minister Sveinung Rotevatn believe the EV perks will be a hot topic in the campaigns, where removal of the perks is said to be a central issue.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. Half an hour into Monday's trading session here for European cash equities. And we're succumbing to the downside, essentially. So even the DAX and the CAC that had made some earlier gains now negative, only down by 0.1%. But add that to the FTSE 100 underwater to the extent of 0.6%. And we are weaker across Europe. Let's get to some of the news flow that we are covering here in terms of deal news flow. Suez and Veolia are making an announcement which has moved their share prices. You can see that both of those stocks moving to the upside, up by more than 7% on Suez, and Veolia continuing to make those gains, up by 5.7%. The two groups agreed on a merger price of €20.50 per Suez share, and we are just hearing from a press conference that is taking place. The Veolia CEO is speaking to journalists at that press conference, saying that the Suez Australian asset sale is cancelled. The deal with Suez concluded during the night, so giving us some really interesting insight into the timing of all of this. And the CEO of Veolia saying they're confident in the business's ability to integrate Suez. So that's one particular French M&A story that we have been following in the utilities space for a long time now. Let's turn our attention to the sector moves then across Europe and across the European equity market space. Earlier on during the session, we had seen the auto sector doing pretty well. It is still in positive territory, but not sufficiently to bring the German market as a whole to the upside. So we see autos and parts to the upside, utilities also higher. Autos and also parts, something of a long-term story, of course, around electric vehicles. Basic resources making moves to the downside, and banks. So with that combination, easy to see why the London market underperforms. Basic resource stocks down by 1.25%. Let's get a Bloomberg First Word News update. For that, here in London is Laura Wright. Laura.
Thanks, Anna. Well, England's pandemic lockdown is easing again today. Non-essential shops and outdoor hospitality will reopen. That includes hairdressers, spas, gyms and more. Scientists at UCL are saying the UK could be about to cross a key threshold. Herd immunity, we've heard that phrase before, but others are more pessimistic, with Imperial saying only 44% of the country has protection from COVID. Iran says an incident at the country's largest uranium enrichment site was an act of nuclear terrorism. It's blaming opponents of talks between the Islamic Republic and world powers to revive the landmark 2015 deal. Iran did not elaborate, but in the past has largely blamed Israel for attacks on its nuclear infrastructure. The Biden administration is stepping up scrutiny of China's plans for a digital yuan. Sources tell Bloomberg some officials are concerned the move could start a long-term bid to topple the dollar as the world's dominant reserve currency. The US wants to see how it would be distributed and if it could be used to get around sanctions. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you very much. Laura Wright here in London. Now, Trustly is planning to raise over $900 million in a stock market listing as the Swedish fintech firm becomes the latest company to see growth amid a surge in demand for online services. Bankers arranging the offering will be mindful, of course, of the recent flop by Deliveroo in its London listing. Very different business, perhaps. But let's speak to the CEO then of Trustly, Oscar Berglund, who joins us now. Oscar, very good to speak to you. I understood from our colleagues in Bloomberg News that until quite recently you were still keeping a number of options on the table, not committing necessarily to the IPO. So what convinced you that now is the right time to go forward with this IPO?
Morning, Anna. Thanks for having me. So I think the board decided eventually to go ahead and pull the trigger on IPO. We have prepared for this for close to a year, improving all our processes. And at the end of the day, it came down to the fact that we wanted to remain an independent company. We want to allow for our existing main shareholder to remain invested in the company for years to come. And yeah, I think that was it.
So that's what drove things. How did that tie in with the decision to list in Stockholm? Is that simply geographical, or were you impressed by the ability of founders and first wave shareholders to stay connected to the business? What convinced you about a Stockholm listing?
So I think the choice really was between Stockholm and New York. We're growing very rapidly in the US. US is becoming our largest market. But at the end of the day, we are a Swedish European company, and this time around we concluded that Sweden would be the place we would want to list. I think nothing prevents us from in the future potentially do a dual listing in New York as well. But for the time being, Stockholm is where we're going to list.
And other businesses in the fintech space have been perhaps considering things like SPACs, special purpose acquisition companies, other ways of coming to market, but you're going for an IPO. What was behind that decision, Oscar?
So obviously there been the main interest from SPACs, but we haven't really entertained those discussions. We want to do kind of call it an old-fashioned listing. We believe in meeting with different investors, building a kind of a broad long-term shareholder base. So we concluded on doing it kind of the old-fashioned way, if you will.
What about the performance of the business, the underlying performance then, Oscar? Clearly, lockdown has had its upsides for many businesses that focus on online payments or online activity generally. And we saw 300% growth in the United States from your business. How much of that is sustainable, though, as we start to see the US and other parts of the world opening up?
Actually, I think there's more to come from us on that, because some of our verticals, like a travel and airlines vertical, has been more or less shut down this last year. We have had multiple years now, track record of several years of good growth and a proven business model. We're making money. And so it's really, I think, more to come as things go back to normal and we can start serving some of our verticals, in particular travel and airlines, where we have a strong foothold.
In terms of the payments business, there do seem to be a lot of businesses in the payment space. Fintech, clearly something we talk about a lot. What is it that makes your payments business different to other payments businesses that might operate in a similar sphere?
Yeah, no, great question. So I think the big difference is we completely bypass the car networks. So a lot of great fintechs, a lot of great payment companies out there that are one way or the other interacting with the car networks. What we're doing is we're building our own global payments network, completely bypassing the car networks. Then on the top of that, we have our own consumer-facing payment method. And then we built all the functionalities that you as a merchant need to accept payments online in an efficient and in effective way. So by means of doing that, we can bypass the core networks that were built for a time and an age when commerce happened in the physical world. There are a lot of pain points with card payments online that we can address. And we also, by means of building our own full-stack payments platform, we can get rid of all the intermediaries and middlemen that you have in any payment card transaction. So that is really what I think differentiates ourselves from a lot of the other companies out there.
Bypassing the core networks, does that require a large amount of infrastructure and investment on your part, though, Oscar? What's the future look like on that front?
It does. I mean, we have connectivity into more than 6,000 banks globally, so we can enable more than 500 million consumers to pay with Trustly. So if you are a merchant with any kind of global footprint, we are an extremely relevant, relevant alternative to the cards. We also have our own settlement network in Europe. So yes, there's 10 plus years of investments going into building this network and payment solution.
There are a lot of fintech businesses thinking about coming to market or having already come to market, Oscar. Does it feel competitive? Does it feel like a very competitive time to be doing this IPO? I imagine you're confident nonetheless.
I mean, we are confident. I think what we have is we have a strong history and track record of both, strong revenue growth as well as profitability. So the way we think about this really in terms of a rule of 80. So our kind of annual revenue growth plus our margin, we want for that to be around 80. And that will also give us some flexibility. So some years we may invest more and we'll see a little bit of lower margins. In other years we maybe have the opposite kind of dynamic. So I think from that perspective, I mean, so having this proven platform, proven business model, and this network infrastructure built to complete ourselves over 10 plus years, I think that's give us the right kind of backdrop, if you will, the right means of going public.
Oscar, thanks very much for your time. Thanks for talking to us. Oscar Berglund, the Trustly Group CEO, talking to us about the business's plans to IPO. Coming up on the programme, hitting the gym, we speak to the CEO of Pure Gym as the lockdown in England eases further and gyms set to reopen across the country today. More on that next. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Welcome back to the European market open. 42 minutes into a negative trading session for European equity markets. US futures points slightly to the downside as well. Nasdaq futures only down by around 1/8% or so. Now, as we've been talking about all morning, phase 2 of the plan out of lockdown here in the UK came into effect today with retail and leisure reopening. That includes gyms, but with the pandemic forcing a change in behaviour and boosting sales of equipment for home workouts, will such businesses see demand return? Our next guest says he expects expects almost 1 million workouts to take place this week. It's a little early on a Monday morning. That's an exhausting thought. Humphrey Cobbold is the Pure Gym CEO, and he joins us now. Humphrey, very good to speak to you this morning. Are you expecting people to come back in socially distant, very safe droves, or are you expecting people to be hesitant?
Well, look, good morning, Anna. I've already been out this morning, and I was in one of our gyms in Didcot in South Oxfordshire when we opened up at 6 a.m. And I have to say I was delighted to see that by 6:30 we'd had about 60 people through the door, members smiling, really happy to be back in the gym. That's busier than a normal Monday morning, and it's not been the easiest morning in South Oxfordshire today. We've had quite heavy snow, which is kind of bizarre. I was able to get in a cheeky workout, one of the first, of those million workouts that we hope to take place this week. So look, overall, I'm reassured by that. My belief is that we'll see members coming back, wanting to get into discipline, activity, enjoy the social environment of the gym, the range of equipment we provide at £20 a month. It's a great deal, etc. And currently, our gyms have all reopened securely this morning. We've got great safety procedures in place.
Okay, good to hear you had your workout this morning, Humphrey. The snow perhaps playing in your favour then, getting people inside instead of being outside. What's been the pattern of people cancelling their membership and then perhaps in the run-up to today's reopening, coming back and taking out membership again? Have you got any details on how that wave has performed?
Sure. Look, inevitably, when you're closed for long periods, and remember, we've been closed with no revenue for 8 months out of the last 12 months, and we've frozen everybody's memberships. We haven't taken any money from people. But nevertheless, people go through their direct debits and they cancel them, knowing our model's super flexible. They can rejoin at any time that they want. But yeah, we reopened this morning with probably 30% or so of our members down and having left us, but they'll be coming back very strongly over the next month or two. I think we'll probably have about between 200 and 250,000 people join us over the next sort of 6 to 10 weeks. So really healthy joiners coming back into our facilities I think everybody needs a little bit of time to reacclimatise with being out there and doing things again. And they'll want to take a look at our facilities and make sure that we've got social distancing in place, that there's plenty of cleaning going on, lots of good ventilation and fresh air, all of which we've got in all our facilities. And I'm confident that we'll see a steady rebuild of our membership base because we provide such an essential service to these people. This is not something that in the main is just for the sort of few anymore. This is a central part of life. There were 10 million members of gyms in the UK in February last year before the pandemic. And this has been a health crisis. People know they've got to look after themselves. And so notwithstanding what they can do at home with their home kit, which is great, I think they'll be coming back to gyms and exercise facilities as well.
Yeah, how concerned are you about the rivalry that you're now seeing then from home kit and from those who've invested in home kit during the lockdown? Because yes, people are coming back, and yes, we're seeing the reopening today, but it's not full reopening. For example, those gyms that run classes, they're not able to operate in the short term.
Yeah, the classes and things like that will be opened after May the 17th, so we've got a little bit longer to wait for that. But on your central point there, in terms of competition with home fitness, look, I'm a fitness fan for everything. I think it's great that people have been more active at home. But what I've seen from working in the sports and activity industry for nearly 15 years now is that when there's more opportunities for sports and activity, people do more of pretty much everything. And so I think what we'll see is people continuing to do bits at home. We've had our app open with classes to anybody in the country, actually, with 400 classes and exercise routines available to anybody who wants to download it through the lockdown. People will continue to use that, but they want to come back to facilities. The average person who comes to one of our facilities uses between £15,000 and £25,000 worth of equipment when they come, lifting platforms and weights and treadmills and cross trainers. And most people can't replicate that sort of variety of activity opportunities at home. And most people can't afford a Peloton bike. I think Pelotons are great. Yeah, I know that the Chancellor's a big fan of those. That's tremendous. Yeah, but they're £2,000 a time, and most people can't afford that to have at home. So we provide a really good economic option for people to get a wide range of activity in a really safe environment.
Humphrey, we're looking at a lot of images at the moment of some of the measures that you've put in place, you and other gyms, around social distancing and trying to keep everybody safe. What are conversations with the government like about how you make sure that the environment is safe? And I'm thinking in particular about whether there's going to be use of any kind of vaccine certificates in the future or sort of immunity certificates. What conversations are you having about whether the gym sector needs to be part of that conversation or not?
Well, we're working very carefully with UK Active, which is the industry body that works on behalf of all the gyms and fitness operators in the country, and inputting into the government's considerations of those schemes. Look, we know there's a lot of discussion about that, and I think you like me, must have found it all a bit confusing as to exactly which way the government thinks it's going to go, and I think honestly they don't know yet. Our general view is that the certification schemes will be appropriate in some environments, big events when people sit next to each other at sort of 40 or 50 centimetre distances for long periods of time. They'll be appropriate there. I think we all know we're probably going to have some certification requirements for going in aeroplanes and things of that sort of nature. How much beyond that remains to be seen. I mean, we're very confident that the protocols that we've put in place, the social distancing, and the way that gyms work means that they're safe without there being certification. We evidence that very clearly in the data that we gathered between the first lockdown and then the sort of November, December lockdowns as well. So we're very confident that as we stand today that people are safe. Of course, we've input into the government's view, sort of citing those statistics and asked them to think very carefully about overburdening people with requirement to show passes. But it would be sort of strange if inadvertently the government wants everybody to get healthy on the one hand and get back to activity and back into gyms, but they put a barrier in the way by making it sort of vaccine compliant or certification required. I think that the costs of that to the nation's health and well-being are likely to be greater than the benefits given the protocols that we put in place. But we're very active in that debate with government.
Okay, we'll watch that carefully then. Humphrey, thank you very much. Thanks for your time. Humphrey Cobbold,
thank you.
Pure Gym's CEO. Thank you very much for joining us. Important day then in the UK reopening story. Coming up here on the European Market Open, we're back to the data, back to the economics. Data deluge in the US. Bond watchers are bracing for a bumpy ride ahead of tomorrow's key inflation figures. We'll discuss what it means for markets next. This is Bloomberg.
Valuations, particularly sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European market open. 53 or so minutes, just about, into our European equity trading session. And you can see the London market, an underperformer today. We see pressure on basic resources and the banking sector. As a result, London underperforms. The Stocks Europe picture broadly a little bit weaker, down by around 0.25%. Joining us now is Laura Cooper, Bloomberg's Markets Live macro strategist. And let me start with the subject of inflation then, Laura, because that does seem to be a big theme of the week. It's been a big theme of most weeks I can think of lately. But let me ask you, because we've got the inflation figures coming out of the US tomorrow, what expectations look like and what the market is waiting for when it comes to that inflation narrative?
Well, it's really going to be all about that U.S. inflation print tomorrow. So markets are expecting we are going to see a spike in that headline print to about that 2.5% rate. And that's largely because we are going to start seeing those base effects feed through from a year ago. We also have climbing energy prices feed in. But I think from a market's perspective, the challenge now is we are in this Goldilocks period for stocks, improving growth, improving earnings expectations, whereas at the same time, really just a contained environment for yields, supportive monetary policy. So if we do start to see those price pressures begin to build and we start to see those Fed rate hike expectations ramp up once again, we could potentially see that spook stocks. So clearly that could be a catalyst tomorrow.
So that's what we're looking ahead to then. In terms of the more immediate story, Laura, it doesn't seem as if the London reopening, the England reopening and Wales reopening story is getting through to markets. All priced in seems to be part of the conversation we've had with guests this morning. London underperforms today, almost ironically, but interesting to see, and certainly a big sentiment lift for those in the UK to see that life returns very gradually, slowly to a little bit of normal.
Absolutely. And, you know, yes, markets aren't as excited as the rest of us to actually be able to go out to pubs and finally get our haircuts. But I think, like you mentioned, a lot of that is already in the price. Yes, the FTSE 100 does have a lot of room to climb relative to its European peers. And when we look at the currency, really, I think a lot of that upbeat expectations about growth is baked in. So euro sterling reached its highest in 6 weeks, and we are potentially seeing that under pressure, but certainly not yet. And again, it's going to be all about the data for the UK as well. Will we see consumers unleash that pent-up demand? We are seeing elevated savings rates. So could us consumers be going out, really provide that catalyst to the UK growth that is largely being priced in across UK assets?
Yeah, markets unmoved by the reopening story. Markets clearly don't need their nails doing, Laura, as some of the rest of us do. Let me ask you the question of the day then around Chinese tech. This has been something of a theme for a while. How big a threat is China to tech stocks at this point?
Well, clearly, you know, it has been quite the dominant story within Asia. We are seeing tech under pressure. Yes, we did see a bit of a bounce in terms of Alibaba today on those regulatory news, but clearly that could be potential ripple effects across the U.S. But again, I do think it's largely a story about U.S. yields dominating that tech story. If we look in the U.S., that reflation trade, the so-called Russell 2000 relative to the NASDAQ, that's actually tumbled over the past couple of weeks relative to what we would expect to see in yield. So really tech has been an outperformer. So that could potentially be shaken once we do potentially see those yields spike higher again on that back of US data, and as well a deluge of supply coming in terms of treasury yields, treasury auctions this week.
Yeah, absolutely. We'll watch out for the supply story as well. Laura, thank you. Laura Cooper, Bloomberg Markets Live macro strategist. That is it for the European market open this Monday morning. Surveillance Early Edition is up next. This is Bloomberg.
model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the US, we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing out at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim. We're going to be riveted to that, and we're going to do what is required.
What we're seeing now is really an economy that seems to be at an inflection point.
Headline inflation is going to likely move above 2% because we're going to be comparing this year's prices with last year's collapsing prices.
What's most important is that we make the investments as a country that we need to, not what we call them.
This is Bloomberg Surveillance, early edition.
Good morning and welcome to Bloomberg Surveillance Early Edition on the Monday, the 12th of April. I'm Yusuf Gameldine in Dubai. Francine is out on holiday, but here are the stories that we are following very closely. The inflection point. Jay Powell says that the U.S. economy is set to see stronger growth and hiring ahead, but stocks waver on worries about inflation and the pace of recovery in developing nations. On track, business optimism soars in the UK as England's easing of the lockdown continues on pace. We'll speak with the managing director of Harrods in this program as pubs, restaurants, and non-essential stores reopen. Alibaba's record fine, China's e-commerce giant, is hit with a $2.8 billion penalty. Shares move higher, but the questions linger on the wider crackdown on big tech in China. Well, let's get straight then to the market action. Global equities are wavering this morning, even as the S&P 500 is on its best run since last October, topping 4,100 for the first time. The Fed Chair Jay Powell, he's weighed in, and he says he's confident in his assessment of the U.S. economy overnight.
What we're seeing now is really an economy that seems to be at an inflection point, and that's because of widespread vaccination and strong fiscal support, strong monetary policy support. We feel like we're at a place where the economy is about to start growing much more quickly and job creation coming in much more quickly. So the principal risk to our economy right now really is that the disease would spread again.
But amid Powell's positivity, fear is creeping back into these markets. For one, you've got a recovery that is looking increasingly less global. And as England reopens and the U.S. continues its vaccination success, Europe is caught playing catch-up, and Indian hospitals are being swamped with new coronavirus cases. Then there's the issue of inflation. U.S. CPI data is expected on Tuesday, and that's likely to show significant jump. Will it derail the stock rally, though? Let's head out to our top market story then with Danny Berger. Danny.
Yusuf, look, we're definitely dealing, as you say, with a market this morning where sentiment looks dull, and we have these various forces, be it sort of the more macro picture you pointed, or a micro one as well. You have to remember, for both Europe and the U.S., we get the kickoff of the earnings season. Expectations are very, very high. So there's a high bar corporates have to meet, and they could disappoint after a pretty strong start to the year in new records. Now, in terms of the 10-year yield, not a lot of movement, but also important to note growth-sensitive assets under pressure today. We're looking at copper down today, all those sorts of metals. So Bloomberg Commodity Index down about 0.5%. And really, the two big drivers for this soggy start to the morning are going to be, one, inflation. So here's the data that came out Friday that saw the U.S. 10-year yield jump, basically holding at that level, a 4.2% rise in PPI. That's more than analysts had expected, but we have to remember that base effect is so strong. But we get this huge data deluge this week. So if CPI also is extremely high Tuesday, perhaps that ramps up fears even more. And the second big driver, and perhaps why those growth-sensitive assets were under so much pressure, is the COVID story. We're looking at global cases nearing a 3-month high, and this is one of the big drivers of that, the emerging markets. We're looking at India's virus situation here. You can see cases absolutely skyrocketing. Turkey as well is seeing this sort of curve. And now it might look like an EM story, but the risk here is that it bleeds in to developed market economies as well, Yusuf.
Danny, thank you for the moment. That's Danny Berger there. Let's get to some of the other important developments on the radar, because England reopens retail and outdoor hospitality. After months of being shuttered, these businesses will reopen their doors to the public today, marking the second stage of the government's roadmap out of the lockdown. The British Retail Consortium says that now customers must play their part for a safe reopening of the UK economy.
A lot of excitement and anticipation in welcoming people back, because many of these businesses have been closed, certainly their shops have, for more than half of the last year across the UK. So it's a really important day for the country in terms of entering the second step of the lockdown, and for those shops in England and Wales, they are opening their doors today.
Well, let's find out how busy it's getting out there. Now, joined by Emma Chandra. She is live on Oxford Street. Emma, what exactly is happening there?
Thanks very much. Yes, here on Oxford Street, of course, one of the iconic shopping destinations here in London. And we've been here since early this morning, and we have started to see activity build. There are queues, long lines starting to form outside of a number of stores. I've spoken to a number of people as well, saying that what is on their shopping list, what they plan to buy, of course. John Lewis, just behind me. John Lewis, one of the stalwarts of the British High Street, of course, reopening its flagship this morning. I spoke to one of their press people today. They said they're expecting people to come through the doors and into the stores. But one should also note, of course, that for John Lewis, since the pandemic, a third of its fleet will not reopen. And that is perhaps the biggest story today about the reopening when it comes to non-essential retail. It is not just those that are reopening, it's the stores that will not reopen. We've seen a number of names go to the wall. The British Retail Consortium, we just heard from them there, also telling us that the cost of the 3 lockdowns in the UK to British retail, some £30 billion.
I mean, I was going to follow up on that a little bit more, because the reality is that you've had a double whammy with sort of Brexit and COVID, and it's been difficult to really quantify the damage that's been done to some of these UK retailers.
Of course, and we're starting to see people attempt to do that now. Of course, the British Retail Consortium putting that figure in terms of the cost of the lockdown. They say sales down about 30% for non-food store-based retail, nearly 70,000 jobs lost, close to 18,000 stores, high street chain stores shuttered. And so there has been a huge cost to retail. A lot of people saying perhaps the worst industry hit by the pandemic here in the UK. There is some optimism, though, of course, and we know that there is optimism because we're starting to see people excited about the new freedoms that they're about to have, but also we see that people do have money to spend. Some £150 billion, Bloomberg Economics tells us, in excess savings. And the hope, of course, is that people will splash that cash, and they will splash it at stores and outside hospitality due to reopen today. I've got to say, it's a little bit cold here, though, so anybody planning to do that might need a few extra layers.
Still sounds like a party. Emma, thank you for those highlights. That's Emma Chandra there. Let's get you a bit of a preview then, because smart conversations are coming up on Bloomberg Surveillance Early Edition. This hour, we speak to the CEO of Citroën. The Stellantis subsidiary has launched a new SUV. But before then, as England reopens its shops, we speak to the managing director of London's world's most famous department store, Harrods, and get a bit of a finger on the pulse on retail. If you have any questions for our guests, you can IB our team. Would love to hear from you. That's on TV Go. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Yusuf Gamiladin in Dubai. Let's get you the Bloomberg First Word News, some of the other key stories we're watching with Leanne Garrett. Leanne.
Good morning, Yusuf. The U.S. Secretary of State is warning against encroaching on Taiwan. In an interview with NBC News, Antony Blinken raised concerns about Beijing's aggressive actions in the Taiwan Strait, adding the U.S. stands by a commitment to ensure the island's self-defense. Blinken also faulted China on its secrecy around COVID-19. Now, Germany's conservatives are split in the battle to succeed Chancellor Angela Merkel. Bavarian state leader Markus Söder is joining the race, taking on the head of the CDU, Armand Laschet. They both firmly declared their bids yesterday. Party leaders are meeting to set up the next steps. Söder's CSU is a sister party of the CDU. And former UK Prime Minister David Cameron has broken his silence over the controversy of his lobbying for Greensill Capital. He's defending his actions, but says there are important lessons to be learned. And as an advisor to the company, Cameron lobbied Chancellor Rishi Sunak, encouraging officials to give Greensill access to pandemic funds. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg Yusuf.
Thank you very much for that. Well, let's get back then to the markets conversation, because stocks are dipping this morning ahead of a busy week of potential catalysts. You've got U.S. inflation data tomorrow that is expected to show a pickup in consumer prices. Then you've got earnings season as well that gets underway. Joining us now is Laura Cooper. She's the Bloomberg MLive macro strategist. Laura, you've had a chance to listen to Mr. Powell from the Fed over the last few hours. Just talk to me a little bit more about the timing of his comments and the language that he chose to use.
Well, on your first point, the timing of the comments is somewhat interesting. Just the fact that, saying that we are at this inflection point in the U.S. economy, that comes after we have already seen the unemployment rate fall quite significantly. We are beginning to see signs that growth is going to be quite exceptional this year. But he did caution again that we are going to see still these looming virus fears that is certainly underpinning their still dovish outlook ahead for the overall monetary policy backdrop. And I really think it's going to be about data going forward. They want to see that data confirm market expectations. We're likely to get that first indication tomorrow with that headline CPI print starting to capture those base effects from a year ago. And really, if we do see an upside surprise in that front, that could potentially spook markets, maybe pivoting towards the Fed actually having to move sooner.
Right, so there is an emerging consensus that it's okay to let the economy run hotter. Fine. But what hasn't quite been figured out is how hot do you let the economy run?
And that's the crucial component, is the fact that since the Fed moved towards this average inflation targeting regime, their openness to letting inflation run so-called hot above that 2% mark brings with it a number of questions. And that is, what is their central bank reaction function going to be? Once we do potentially see headline prices above that 2% mark for a sustained period of time, which is a risk, that could begin to question, well, how could the Fed actually respond? The Fed has said that it does have the tools needed to respond, but crucially, it's about those anchored inflation expectations. If we do see those start to decouple from that 2%, that could raise some questions at the Fed.
It's a busy few days for the Treasury. You've got $58 billion in 3-year and $38 billion reopening in 10-year notes. And then add to all of that $24 billion reopening in 30-year bonds on Tuesday. That suggests to me that there's still quite a bit of more potential volatility and more potential pain. What have you penciled in then for Treasury yields in the coming days?
Well, certainly, I think after the week that we saw last week, it was a fairly quiet week in terms of the Treasury action. We did see bonds were bid. We did see the yields touch about that 160 mark last week. And so going forward, really the question is, will we continue to see appetite for bonds bid, given that we are going to see this deluge of supply come in? And if we think about 6 weeks ago, we did have that 7-year auction that did spark this incredible bond volatility. So that does remain a key risk going forward this week. Will we still see that appetite going forward for bonds, or could that be the next catalyst for markets?
One story that caught my eye from your team is around gold and how it lost some of its momentum because of basically the ETFs bailing and a lot of money getting out of those funds. But now it comes back on the radar because the central bankers, out of everybody, are interested again.
Well, and gold has been actually quite an interesting story, because we did have the precious metal fall to its lowest since last June, only a couple of weeks ago, and that has been dominated by the factors that you mentioned, like that ETF coming under pressure. But now what we've seen is that those fundamental drivers, so rising yields, the weaker dollar, those did begin to bolster gold once again. So we did see that climb above that 1750 handle. So I really do think once we get some direction in terms of yields this week, which will spill over into the US dollar, that is going to set the tone for gold. So yes, central bank demand is more of a longer term story, but I do think it's all about those key drivers of the dollar and the yields in order to support or really likely send gold lower in the week ahead.
I'm looking at the euphoria that is taking place in certain parts of the UK because of the easing of restrictions, very much in contrast with what's taking place in Germany, where we're looking at potentially a new lockdown. But globally, the number of cases, they're increasing, and the number of fatalities are moving higher as well. Is there a risk that the market is not pricing in the scenario sufficiently of another setback, of a full-blown third wave?
And I do certainly think that that is a risk. So for what we've seen right now, forward-looking markets are focused on the fact that we do have these vaccine rollouts coming through that is dominating any kind of the virus risk that we are seeing. But like you mentioned, we are starting to see cases tick higher. We did have Indian cases at a record that is spilling over into the commodity sector with demand likely under pressure. But really in the US and in Europe, it's been more a case of just getting those vaccines to people, and markets focused on, yes, these economies will eventually recover. It's all about the consumer. And so that Goldilocks environment for stocks continues to persist, with virus a risk, but certainly not one that markets are focused on at this point.
Laura, it's been great catching up. Thank you very much for running us through some of those themes. Laura Cooper, Bloomberg's MLive macro strategist. Let's get you a bit of a snapshot then of what else is coming up. Alibaba shares surge after the company gets hit with a $2.8 billion fine. The Chinese tech giant thanks regulators for ending a months-long period of uncertainty. We're going to get the full story from Hong Kong on what it means. This is Bloomberg.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Yusuf Gameldine in Dubai. Alibaba shares gained some 6% in Hong Kong today after it received a record $2.8 billion of an antitrust fine. That's less than many were expecting, though. Chinese tech giant responded by, wait for it, They actually thanked regulators in an open letter. They said that Alibaba would not have achieved our growth without sound government regulation and service. Well, let's get some more analysis on this with Bloomberg opinion columnist Shuli Ren. She joins us from Hong Kong. Shuli, this looks like a sigh of relief then for investors. What does it mean for the company's medium-term outlook?
Well, 2.8 billion is a lot of dollars, but Alibaba is a very, very profitable company. Just for references, like 2.8 billion is only 4% of Alibaba's annual sales and 11% of its annual free cash flow. That's nothing compared to the billions of dollars lost in terms of market cap. If you compare Alibaba to Tencent shares, in the last year, Alibaba underperformed Tencent by 30 percentage points. We're talking about hundreds of billions of dollars. So Alibaba has something to be thankful for, like at least the other shoe dropped. So in that sense, perhaps the investors will say, the Chinese regulators for the time being are done with Alibaba and we can move on from there. 2.8 billion is a lot of money, but it's only 11% of annual free cash flow. It's not that bad.
If I put myself in the shoes of big tech in China, I'd be pretty worried right now. And that raises the question as to what this outcome tells us about Beijing's clampdown on antitrust.
I think it's an interesting signal. I mean, this whole clampdown on big tech, it's a trend globally, right? But if you look at the big tech in the U.S., their stocks are not affected at all. In part because the U.S. watchdogs, the regulators, they keep on dragging the big tech to the Congress to talk, but there have been no fines. So that's one way to have the big tech having antitrust issues, but not having their stock prices affected. On the other hand, China is an interesting story. I mean, it would be really bad if the regulators just keep on dragging, talking bad things about Alibaba on the People's Daily editorial without handing down a decision. At least a decision has been made. And in part, perhaps, I mean, the antitrust regulators, they don't have money. So they want the 2.8 billion. But the big question is...
Shuli, I mean, if I could just very briefly ask you, how is this being sold domestically? How is the story being shared in China?
I think they're trying to compare, if you look at the Chinese local media, they're trying to compare the China situation with the U.S. and Europe. And they say, this is not unique to China. In U.S. and Europe, the big techs are being scrutinized as well. That's what they're trying to do. They don't want to be seen as the only oddball out there. They're just going with the global trend. That's what they're trying to perceive.
Shuli, we're going to have to leave it there. Thank you very much for that. That is our Bloomberg opinion columnist, Shuli Ren, on a very important story out of Hong Kong. Now, in terms of where England is, they're reopening retail. We are going to be speaking to the managing director of one of the country's most famous shops. Up next is Michael Ward from Harrods. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The inflection point. Jay Powell says the U.S. economy is set to see stronger growth and hiring ahead. But stocks waver on worries about inflation and the pace of recovery in developing nations. On track, business optimism soars in the UK as England's easing of the lockdown continues on pace. We're going to be speaking to the managing director of Harrods in this program as pubs, restaurants, and non-essential stores reopen. Germany's succession fight. Bavarian state premier Markus Söder throws his hat into the ring to succeed Angela Merkel as chancellor, challenging the CDU chair Armin Laschet. Good morning, I'm Yusuf Gameldine in Dubai, and welcome to Bloomberg Surveillance Early Edition on Monday, the 12th of April. Francine is out, and I'm in the cover. Let's get to the story out of England now, because the country is reopening retail and outdoor hospitality. After months of being shuttered, these businesses will reopen their doors to the public today, marking the second stage of the government's roadmap out of the lockdown. But what will the UK retail landscape look like? Let's get a bit of a snapshot. We're now joined by Emma Chandra again. She is live on Oxford Street, braving the cold, I'm told. Emma, how does it look like at the moment?
Well, after nearly 100 days of lockdown, when these streets were basically empty, we are starting to see people return to this iconic shopping district in the West End of London. We're starting to see queues and lines form outside of stores. I've spoken to a number of people eager to buy things that they've been unable to buy in person over the last 3 to 4 months. But whilst we're talking about the reopening of non-essential stores here in the UK today and what this means for the retail industry, perhaps the biggest thing to focus on, of course, is what will not reopen. We know there has been a huge cost to British retail over the course of the last lockdown and indeed over the course of the past year. The British Retail Consortium telling us that it's cost the retail industry some £30 billion over the last year, close to 70,000 jobs lost and nearly 20,000 chain stores no longer going to open. Those outlets shut for good. Still, there is palpable excitement, especially because Brits have managed to amass £150 billion in excess savings over the course of the pandemic. Retailers really hope they are willing to splash that cash, and they've been doing a lot to make their stores safe so that people feel happy to come and shop in store. Nevertheless, one company here that monitors what's going on in the West End telling us they expect foot traffic to only reach about 40% of what it was pre-pandemic. So a lot of businesses saying they're going to need support from government in the weeks and months to come.
Emma, thank you for that. That's Emma Chandra. She will be reporting from Oxford Street all morning. Let's stay with England's retail reopening, as one of the world's best-known department stores is also going to be among those welcoming customers back. Let's get to Harrods, because a fixture in West London since 1849. Harrods has been owned by Qatar Sovereign Wealth Fund since 2010, sitting on 90,000 square meters of retail space. It's one of the world's biggest department stores. Joining us now is Michael Ward. He's the Harrods Managing Director. Michael, welcome to the program. Just run us through the kind of preparation that you've been undertaking and what kind of success you hope to lock in the coming hour.
Well, thank you. It's one of those things that takes many days to reopen a store of nearly 1 million square feet. So we've been cleaning, we've making sure that everything is perfect, all the signage is there for social distancing. We still have the counters on the doors to make sure the environment is safe for all of our customers. And we've just been getting gradually ready. So building up in the production kitchens, because everything we make in the food halls is all produced by our own chefs. And all of this takes a huge amount of precision and detail. And we're up and ready, and we are so excited to be opening the doors today at 11 o'clock. I think the other point, though, we think we'll come back pretty quickly, because I think what's the common theme? People want things that are interesting, they want new, and during the whole of lockdown we've been working on that. We've got hugely supportive shareholders, so we've continued building, and what you'll see if you come today is new Hermes boutiques for women, new Loewe, Paolo, Ibiza collections. So we've been continuing to invest in theatre.
Michael, how quickly a recovery can you pull in top line, in bottom line, over the next few weeks, do you reckon?
I think this is not weeks. This is going to take us years to recover back to where we were. And London was dealt a severe blow, not only by COVID, but the government wanting to change the VAT registrations. And that will mean that foreign visitors won't put us as their number one. So we've got two things we're hitting at the moment. There's COVID and there's the VAT res. We think this is going to be 3 to 5 years before we get back to 2019 levels.
What is your read on supply chain pressures? Because you're obviously involved at different levels in terms of the value chain. Are there any signs of price pressures, of supply shortages? Can you give us a bit of an update on that?
I think in terms of, we trade really at the very top of the market, and that we're constantly seeing movements in around prices, but the big brands like to keep price equality across the whole of Europe. So when we see prices move in Paris and Milan, we usually start to see them move in the UK. So they like to see prices the same, so people are not shopping on price. So we don't see any real issues on supply. I've been through the food halls this morning. There are no issues at all in getting any of the produce through the borders into the UK. So, you know, we're opening absolutely at the top of our game.
Now that you're back up and running again, what else would you urge the government to do in terms of supportive measures that it can help either sustain or accelerate the momentum that you're beginning to generate?
I think the big issue that all retail businesses face is that of rates. It's a system that was developed hundreds and hundreds of years ago and has never been fit for purpose. So I think the government has got to start looking at a level playing field for retail, so that we are on a level playing field with the internet, which clearly we're not. So a total reform of the rate system needs to be put in place.
Michael, what about the composition of your customer base? I mean, to what extent does that evolve as a result of COVID and as a result of still some travel restrictions that remain in place for what would be important source countries? I'm thinking along the lines of Qatar, Saudi Arabia, and the United Arab Emirates.
And there will be a gradual return. The people that we speak to, because these are really close friends of ours as customers, and we're on the phone to them almost weekly, and they're desperate to come to London. I think the one thing that we need is a clear visibility on a vaccine passport, so that people can be sure that when they come into the UK, they know exactly what to expect, and we can get efficiency through our borders where we've had large queues. So we need a vaccine passport, but across the whole of the Middle East, people are desperate to come and see Harrods again and renew friendships, because it's not just about shopping, it's about actually everybody has friendships across the store.
Michael, it's been great running through some of those views. Thank you for making the time. That's Michael Ward. He's the Harrods Managing Director. Well, still to come on the program, Citroën unveils a new car, the C5X. We're going to be speaking to the CEO, Vincent Kobe, on the launch and the impact of COVID on the auto industry. That's coming your way. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Yusuf Gameldine in Dubai. Let's head back out to your Bloomberg Business Flash with Leanne Garens. Leanne.
Hi, Yusuf. French waste and water management rivals Suez and Veolia have agreed to merge. It comes after a long and bitter takeover process and counter-offers from private equity firms. Veolia is buying out Suez at €20.50 per share. That is an over 11% premium to its close on Friday. Now, after a record $2.8 billion antitrust fine, Alibaba is thanking regulators. China says the firm abused its market dominance. Alibaba said it would not have achieved its growth without sound government regulation and critical oversight. The penalty is less severe than many actually feared and helps lift the cloud hanging over Jack Ma's internet empire. And Microsoft is making a massive bet on healthcare artificial intelligence. The software giant is set to buy Nuance Communications. It's been collaborating with the firm since 2019 on tech to allow doctors to capture voice recordings and enter the data into electronic medical records. We are told if these talks are indeed successful, it could announce the deal as soon as today. And that's your Bloomberg Business Flash. Yusuf.
Thank you very much. Let's talk about Angela Merkel, because her conservative bloc is heading for a two-man showdown over its candidate to succeed her as German Chancellor. And that's after the leader of Bavaria's ruling party threw his hat into the ring this weekend. Joining us now is Aggie Cantrell in Berlin. Aggie, where does the party go from here? Is there any sort of signaling that's emerged?
Yes, so both the CDU and their sister party, the CSU, will be holding meetings separately today. The CDU is currently meeting in Berlin to discuss who they should back as a bloc going into the September national elections. And the thing is while Söder is still very much the favorite in the polls more broadly, there is a general understanding that Laschet, as the leader of the part of the party which represents 15 of Germany's states, as opposed to just one, sort of is the big sister party and sort of has precedence over the CSU. So it's still very much up for debate, but it is really just between those two party members.
What I've noticed in the last few weeks is how vicious the domestic debate is in Germany around these prolonged measures that could come into play to contain the coronavirus. How is that likely to sort of move the dial when it comes to elections?
Well, it's just at the moment, the issue in Germany is very much one about these measures, as you say, being extended every couple of weeks for longer and longer periods, and no end being seen for, in comparison to, for instance, the UK, that has set dates in place for when different parts of the economy will be allowed to reopen. Germany hasn't done that to the same extent, but it looks like the CDU's drop in the polls, which some people have attributed to those lockdowns, has somewhat tapered off, and they still do have a lead above the other parties, even though it is a much smaller one than it was at the start of the pandemic. So we might see that they may be able to hold on to this lead, especially if they manage to get the vaccine campaign really underway.
Aggie, thank you for that. Aggie Cantrell there in Berlin. Well, nearly 2 hours into the European trading session, that's high time that we take a closer look at how the momentum has evolved, or the lack thereof. Danny Berger joins us. Danny.
Yeah, Yusuf, it's true. The equity indexes themselves not really going a lot of places. However, underneath the surface, it's really interesting to see that a lot of the budget airlines are under pressure today. EasyJet, Wizz Air, Ryanair. This stock, for its part, is down 2.5%. Perhaps it is some of those virus fears coming back up. What is travel going to look like, especially for these short-haul flights? Veolia and Suez, of course, the big story, finally agreeing to a merger. Veolia taking over Suez for €20.50. Quickly want to flip it over and look at what's happening in the U.S. as well. We have this big acquisition from Microsoft of Nuance, the AI company. That's moving shares up a lot. Anything Bitcoin related also moving up very, very heavily. So Marathon is up, Riot is up. If you are Bitcoin blockchain related, you're going to be doing well as Bitcoin pierces through $60,000 rather. So that's up 7%. Remember, we also have that Coinbase IPO on Wednesday, so that might be moving the needle here as well. And finally, Alibaba. Look, we saw these shares rally as much as 9% in Hong Kong, so it stands to reason that the U.S. ADR is going to follow suit. So pre-market, Alibaba up nearly 6%. Of course, they're paying that huge fine, so that helps to lift some of the concern out of the market that this will be it. So that allows Alibaba to rally from here on out, Yusuf.
Danny, thank you for the moment. That's Danny Berger there. Well, coming up, we're going to talk cars. We'll talk about Citroën specifically. They're unveiling their new vehicle. It's C5X. I'm going to speak to the CEO, Vincent Kobe, on the launch and the impact of COVID on the auto industry. That's coming up. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Yusuf Gameldine in Dubai. The French automaker Citroën is now part of Stellantis, which was formed, you'll recall, from the merger between PSA Group and the Fiat Chrysler Group. Today, it's set to unveil a new car, the C5X. The new model is available in both petrol and plug-in hybrid versions. Joining us now is Vincent Kobe, Citroën's CEO. Vincent, so a new crossover. Explain to me the market positioning around this new launch and how this is a crossover, but not a real crossover.
Hello, and thanks for having me today.
what I would like to say about C5X is the customer need we want to fulfill is what we call touring. You know, this high quality journey using relevant technology in the most serene way to go and discover new places, new people. So C5X, the car you see behind me, you could call that a hybrid or a cross, but fundamentally it's driven by the imagination of our product people and designer to answer this issue, touring. What you want is elegance, fluidity, comfort. At the same time, you want functionality, what you used to find in a traditional station wagon. And the last 10 years, SUVs have taught you that egress, egress, eye point were also a source of visual comfort or perceived safety. So we put all of this together and created C5X. High stance on the road, very elegant silhouette, and an extremely comfortable experience on board.
I mean, I like cars, and this design definitely has caught my attention as well. Vincent, how many of these do you think you're going to be able to sell?
So, you know, we don't do sales projection. What is very interesting to know is you have two large markets in front of us. One of them is Western Europe, where the segment is, say, between 800,000 and 1 million cars per year, acknowledging the fact that C5X can also be a very attractive proposition for large SUV customers. So we will be drawing on a pool of more than 1 million cars per year. And the second country where there is a substantial demand for such a vehicle is China, where the segment is somewhere between 2 and 2.5 million. So we hope to have a strong success in those two pools of customer, and it will probably be reasonably well balanced between China and Western Europe.
This car is going to be produced in China, though. Is that the beginning of a new trend, would you say?
I would say, you know, Citroën, obviously, and beyond Citroën, Stellantis, we take a very rational and balanced approach on manufacturing allocation. In the case of Citroën, we manufacture cars in France, in Spain, in Italy, in Portugal, in the UK, in the Czech Republic, in the Slovak Republic, and beyond Europe, in Latin America, in North Africa, in India, and in China. And we adjust the location based on, obviously, customer demand, the availability of capacity and platform localization, and also the capability to bring the right technology and quality. In the case of China, what is striking beyond the fact that the platform we're using is already present in China is manufacturing quality in China is one of the best in the world, and we believe our customers deserve the best of quality.
What about the chip shortages that have hit some of your peers? And in fact, it's gone even far beyond the auto industry. This is a global shortage. How have you been dealing with that?
Yeah, as you know, this crisis of chip shortage is driven by, I would say, far-reaching consequences of the COVID crisis, where demand forecast was very volatile, and some tier 2, tier 3 players have taken decision in terms of capacity development, and today are creating chip shortage issues. So this has hit a lot of industry, the car industry being one of them. Within Stellantis, I think we've had a fairly strong, quick, and agile reaction to the particular crisis. We took direct contact with those tier 2, tier 3 suppliers to ensure transparency, to ensure the best continuity of production, with the ultimate goal to serve our customer demand, because at the same time, we enjoy a very strong order portfolio. We've taken a lot of steps, obviously transparency and reactivity of the supply chain. Mm-hmm. We've looked for alternative solutions, both from a technical chips, but also from a mix of grades and vehicles point of view.
I look at your registrations in February, and they're down about 25% compared to a year earlier in France. When are we going to see the rebound at Citroën in terms of the registrations, in terms of the sales numbers? Can you give us a bit of insight on that front?
Yeah, there's very dimensions you need to look at. Citroën has gone through a very substantial repositioning, regeneration of its brand in Europe and beyond over the last 5 years. This has brought us to cut a long story short, a 5% market share in Europe. So we are back to this 5% level in February as well as in March, take or leave some variations month on month. The markets themselves have recovered versus 2020, but not yet to the level of 2019. So I think the markets will probably come back to their previous 2019 level, hopefully in the second half of the year. We're still in a very unstable environment, countries to countries in Europe. So you will see Citroën launching new models like C5X or C4 some months ago, and enabling a continuous market share growth in Europe. And when the markets come back, you can see us to our best shape.
Vincent, are you still on track with your electrification plans for part of your fleet, or have you started recalibrating some of that?
We're completely on track. During 2020, we launched 6 models on which we developed an electrification solution, from the convention braking mobility object called AMI, all the way to C5 Aircross adopting a plug-in hybrid solution, not to forget the vans in which we offered a fully electric solution. Today, we're launching C5X with a plug-in hybrid solution, and we'll continue doing this, offering an electrified solution to each and every car we launch, progressively to have a fully electrified lineup no later than 2025. So we're on track.
Okay. Vincent, it's been great catching up. Thank you for that. I look forward to taking it for a spin soon, the new car. That's Vincent Kobe. He's the Citroën CEO. This is Bloomberg.
This patch of land in northwest Saudi Arabia is going to become Neom, a city powered entirely by renewable energy. The government hopes the site, which is the size of Belgium, will be a clean energy hub, not only for the kingdom, but also the world.
This here is at the borderline between Mission Impossible and Suicide Mission. Lucky enough, so far we've just been on the right side of the line, yeah. But you know, it's very close to that. You know, this is just smoking. This is nothing ever I've seen or heard of the dimension, the challenge. You know, I'm not talking energy only. You know, but in its broadest context, including the geopolitical dimension, including the cultural dimension.
Neom will include a $5 billion hydrogen plant run on wind and solar energy. All of the zero carbon fuel it produces will be shipped to international buyers in the form of ammonia. When it starts operating in 4 years' time, it will be one of the biggest hydrogen facilities in the world.
Can't explain Neom on the back of a set of PowerPoints and a video clip. You just need to be here. You need to, breathe it. And specifically the startup mode and, things happening, buses all around you here.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
What we're seeing now is really an economy that seems to be at an inflection point.
Headline inflation is going to likely move above 2% because we're going to be comparing this year's prices with last year's collapsing prices.
What's most important is that we make the investments as a country that we need to, not what we call them.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Good morning from New York and Berlin on this Monday, April 12th. Our top stories today. Powell prognosticates the Fed chair sees the U.S. economy making a strong rebound. Still, there is one catch. Angela Merkel's conservative bloc heads for a showdown this week as the lockdown eases in the United Kingdom. And Microsoft's big bet, the software giant is set to acquire a healthcare artificial intelligence provider. Matt, happy Monday, fresh off the weekend. And it is one of those Mondays that feels like there isn't that much going on. I wonder if we're all just going to kind of be in a holding pattern until we get to that inflation data here in the U.S. tomorrow.
Yeah, I think inflation data is going to be key tomorrow for sure. But here in Europe, there is a lot going on. Not only can Brits go to the pubs for the first time in many, many weeks, but Germany will decide its chancellor candidate, at least for the CDU bloc, for Angela Merkel's bloc. So it's going to be very interesting because the CDU normally sends its leader to the polls. Armin Laschet got the vote from them today, but the CSU, its sister party in Bavaria, has a candidate in Söder who is much more popular with the people. So it'll be interesting to see how this turns out, Kaylee.
Yeah, interesting for sure, and we'll have more on that story in just a minute, Matt. But I do want to get a quick check on the markets because it was a risk-off tone really all across the world, starting in the Asian session where stocks were broadly lower. We were down 1.74% on the CSI 300 in China. Hong Kong stocks lower as well. Japan, a little bit of outperformance, but still it was a red day for the Nikkei. And I would note, too, the underperformance of Indian equities. The Sensex is down 3.5% as we continue to see COVID-19 cases really escalating in that country. Now, as for one of the individual movers I wanted to point out from the Asian session, it was Alibaba. Shares up 6.5% after the company agreed to pay a record $2.8 billion fine to China after an anti-monopoly probe, but it removes kind of that overhang of uncertainty, and that fine isn't as bad as some people were expecting. I would point out, too, that in the FX space, the yen is getting a little bit of a safe haven bid with this risk-off tone we're seeing. It is stronger against the dollar by about 0.2%, sitting at 109.47. Now, stocks in Europe are following Asian equities lower. We are down about 0.5% on the stock 600, or 0.25%. We're down about 0.5% on the FTSE 100 in the UK, even as you say, Matt, the UK is starting to reopen today. I would note, though, that while stocks are weaker, maybe part of that has to do with a stronger currency because the British pound is the outperformer in the G10 space. It is stronger against the dollar today by about 0.3%. The cable rate sitting at 137.46. And in the bond market, not major moves. We're down just a basis point on the German 10-year bund yield right now, sitting at negative 32 basis points. Here in the U.S., no surprise, futures are pointing to a lower open. We crossed 4,100 on the S&P 500 on Friday. Today, though, futures E-minis down about 8.5 points as we see really steadiness in the bond market ahead of a $38 billion 10-year auction later today. The 10-year sitting right now at 1.65%. The dollar is stronger, but it is really a fractional move. And just keep an eye on oil as well. It was lower earlier on the session, but WTI attempting to stage a little bit of a bounce back is up about 0.4%, sitting at $59.53 a barrel, Matt.
Yeah, we have a number of auctions coming out today, so it'll be interesting to see how those work out. I'll be watching John Farrow for his take on that a little bit later on. Right now, let's look ahead to what's going on throughout the week. Today, the Biden administration's top national security and economic advisors will meet with semiconductor and auto manufacturers. And as Kaylee just mentioned, in England, pubs and restaurants with outdoor space will reopen after nearly 100 days of lockdown. Will be difficult, probably, to get a reservation. Tomorrow, OPEC publishes its monthly oil market report, and that's the day on which we are likely to find out who runs for chancellor from the CDU-CSU bloc. On Wednesday, we'll hear from the ECB President Christine Lagarde, as well as Fed Governor Jay Powell, and bank earnings season kicks off big time on Wednesday as well. We get JP Morgan and Goldman Sachs. Citi and Morgan Stanley follow this week. Then finally on Friday, there's a White House summit between Japanese Prime Minister Suga, probably very happy about the Masters results, and President Biden, who I'm sure will congratulate him.
I'm sure he will. You're right, Matt. There is a lot going on. It is going to be a very busy week. And of course, with the UK reopening, that's where Francine is. She's at the pub. Maybe she's out shopping. I don't know. Either way, she's not here today, and we certainly miss her. Of course, let's have more on the UK. And after almost 100 days of lockdown, non-essential stores, as well as pubs and restaurants with outdoor space, will reopen today. It's the latest stage of the UK government's roadmap out of lockdown. Joining us from Oxford Street in central London is Bloomberg's Emma Chandra. Emma, what is it like on the ground? How's the reopening going?
Good morning, Kaylee. Well, shops on Oxford Street, one of the most iconic shopping districts in London, if not across Europe. Stores just reopening. We've seen long lines building outside some of the best-known names, the likes of John Lewis just behind me, also Selfridges, that big department store further down the road. Those shoppers now being allowed back in store for the first time in around 100 days. And really some palpable excitement among retailers as well, really hoping that having had to be closed for so long, that they're going to see people come back through the doors, that those habits of online shopping throughout the pandemic are not going to die hard, that people will return to store. And they certainly hope that people will spend money. We certainly know that Brits do have money to spend. Bloomberg Economics finding that Brits have some £150 billion in excess savings, and retailers hoping that they're going to be willing to spend those in store today and over the next few weeks and months.
So what's it going to be like getting reservations, Emma? Do you have to make reservations at all these places? I know pubs and restaurants only with outdoor space will be serving customers, but I'm sure everybody has been waiting and preparing to go out and eat in public.
That's certainly true. I mean, for anyone planning to do that today, I would say put on a few extra layers. We're going through a bit of a cold snap here in London today, so any outdoor eating or drinking will be pretty chilly. Depending on the venue, you need reservations. Certainly, you can't just go up to the bar when you go to the pub anymore. You need to be able to be sat down at a table, so those spaces will be at a premium. Of course, when we look at what that industry, the hospitality industry and the retail industry, they've had to spend millions and millions of pounds in order to get themselves ready for this reopening, because first and foremost, they want their customers, their patrons, to feel safe. And we certainly know that in retailers, they will still be seeing plexiglass. People will still need to be wearing masks. There'll be a lot of hand sanitizer and a number of associates making sure that there's social distancing when it comes to queues and lines. And of course, remember, the pandemic has wreaked havoc, especially when you look at the retail industry, perhaps the worst hit industry in the UK over the pandemic. The British Retail Consortium telling us that the 3 lockdowns we've seen here costing the industry some £30 billion. 70,000 jobs lost during that time, and also we're looking at some 17,500 chain stores on high streets that have closed. And perhaps whilst we talk about reopening, we should reflect, of course, that there are a number of stores today that will not reopen. A number of big names have gone to the wall. I'm thinking of Arcadia Group. Topshop had its big flagship here at Oxford Circus, and that won't be reopening along with their stores across the country. And John Lewis, just behind me, that flagship is reopening today, but we know a third of their fleet across the UK will not open their doors again.
All right, Emma Chandra there reporting on the reopening in the UK. Thanks very much. Let's turn back here to Germany. Angela Merkel's conservative bloc is heading for a two-man showdown over its candidate to succeed her as German chancellor. That's after the leader of Bavaria's ruling party threw his hat into the ring this weekend. Joining us for more is our Germany bureau chief, Daniel Schäfer, out of Frankfurt. So, Daniel, what do we know so far? Has the CDU confirmed Laschet, and does it look likely that the CSU will confirm Söder?
Yeah, good morning, Matt. So, first of all, this is a very significant moment, obviously, for Germany, as it will likely define who will succeed Merkel after the September elections and thus shape the politics in your biggest economy for years to come. The showdown that you mentioned is happening right now. The CDU leadership is still discussing. What we're hearing is that Laschet, and we heard that in the past few days as well, has generally broad support within his party. But we don't have a decision yet, a formal decision from his party yet. So what will happen today is that all eyes will be on the CSU, which is the smaller Bavarian part of Merkel's bloc, which will also hold a leadership meeting this afternoon, and they will have to decide whether they want to back Laschet, so the contender from the main party, or whether they want to back their own chairman, Söder, and who also is the Bavarian premier. Now, Laschet, from what we're hearing, still seems to be very much a more likely candidate to succeed Merkel, but the problem with him is that he scores badly and worse than in the polls than Söder, so he's less popular. And so he could be from an election strategy perspective, he could be the not so good choice compared with Söder. But then again, Germans like stability, so he could still in the end win the vote and become Chancellor of Germany if he becomes the candidate of the CDU-CSU bloc.
All right, Bloomberg Germany bureau chief Daniel Schäfer staying on top of that story for us. Thank you so much. And now we want to turn to a major deal that's closing today. French waste management company Veolia has agreed to buy its rival, Suez. It ends a long-running and bitter takeover battle. Joining us now with more from Paris is Bloomberg's Caroline Conan. Caroline, what's the latest? This thing finally going through.
After 7 months of a very sharp battle, Veolia has agreed to pay a little more, 20.5 euros, to buy the remaining 70% of Suez it doesn't already own. So that's higher than the initial 18 euros offer that was considered as unacceptable by Suez. So this deal values Suez at 13 billion euros, and it's going to create a global water and waste giant with nearly 40 billion euros in annual revenues, with plants all over the world treating everything from drinking water to hazardous waste. It's been very intense. The hostile approach by Veolia is not exactly part of the French corporate culture, so it led to various battles in court and in public arenas. Suez resisted, tried to block the takeover by offering to sell various assets. But the French government actually was on board from the beginning and said the combination made sense to resist rivals in the recycling business, especially from China. So next steps, the two will enter a definitive agreement by mid-May. Then there will be antitrust approvals from various countries. But investors are pleased with the outcome today. Shares of both Veolia and Suez are up as much as 8% this morning.
All right, Bloomberg's Caroline Conan in Paris, thank you so much. And speaking of stocks that are up on deals, I want to take a look at a few that are moving in pre-market trading here in the U.S. There were reports over the weekend that Microsoft is set to buy Nuance Communications. It is a healthcare AI company that is tied to Siri voice technology on Apple products. Its shares are higher by 18.5% before the bell. Microsoft, for its part, up about 0.25%. The price being discussed could value Nuance at around $56 a share. Right now, it's around $54. You also have Luminex, which makes COVID-19 lab tests higher after Italian diagnostics company Diasorin agreed to buy the company for $1.8 billion. That's a 12% premium to Friday's closing price. It's up about 11% in early trading. And then finally, RiceSpac is higher by about 5%. Some follow-through optimism after it announced it will merge with two other companies to create a $1.2 billion renewable gas giant last week, Matt.
All right, Kaylee, thanks very much for that. Coming up next, Frederic Ducrozet. He is Pictet Wealth Management's global strategist. We'll talk to him about how the EU is doing in terms of supporting its member states. And after that, on the recovery in Europe, Klaus Regling joins us, Managing Director of the European Stability Mechanism. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing out at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim. We're going to be riveted to that, and we're going to do what is required.
What we're seeing now is really an economy that seems to be at an inflection point, and that's because of widespread vaccination and strong fiscal support, strong monetary policy support. We feel like we're at a place where the economy is about to start growing much more quickly and job creation coming in much more quickly. So the principal risk to our economy right now really is that the disease would spread again.
And that was Fed Chair Jerome Powell speaking on 60 Minutes over the weekend. I'm Matt Miller here in Berlin. Kaylee Lines is in New York. Francine Lacroix is on a one-week extended pub crawl as Britain reopens for outdoor dining and drinking. Now, I have an interesting chart here. If you want to take the wide shot, I can show you the debt buildup. And for our listeners on London DAB Digital Radio, what this shows basically is that the massive amount of debt to GDP, over 100%, that's the kind of thing that you see in Italy. It's the kind of thing that you see in the U.S. Even the U.K. has more than 100% debt to GDP. Here in Germany, we're only at 70% debt to GDP. So you'd think there's a lot more spending power, a lot more room for some fiscal help. And we're going to bring in Frederic Ducrozet right now, global strategist at Pictet Wealth Management, and ask him, Frederic, do you expect more fiscal stimulus out of Germany, and really the broader question and more important question, out of the EU?
Yes, we do. We think that the bumpy road towards herd immunity, as Europe is finally catching up with the US and the UK, still requires some support. So it might not be those huge packages, obviously, you've seen in the US or even in Europe last year, but you still need some targeted support, fiscal support to prevent perhaps a larger rise in unemployment and a weaker trajectory for the recovery. That's actually what we've seen already emerging and discussed in Germany, in Italy, in France, where, to be honest, we discussed the level of debt to GDP. Indeed, it's high. But what matters is the dynamic of the debt, the level of interest rates, of real interest rates, and overall, let's admit it, we still have wide room to maneuver. I think it's interesting also to note that the governments took opportunity and have borrowed the highest number ever of new debt at longer maturities in the first quarter of this year. And I would expect this trend to continue at least through the summer.
But Frederick, as you say, the fiscal stimulus in Europe is very small relative to what we've gotten here, where I speak to you from in the U.S. How do you think about allocating regionally now, given all of the stimulus the U.S. already has filtering its way through the U.S. economy and the better vaccine rollout here relative to Europe?
Well, first of all, I wouldn't say it's small. In historical European standards, at least it's one of the largest fiscal stimulus, but relatively to the US, it's the point that the IMF made last week very clearly. We are far from this level that would lead to an overheating of the economy. And more importantly, we are facing a delay, a very risky delay in the implementation of the recovery fund. It's this legal/institutional cacophony in Germany that was led by the decision of the Constitutional Court to delay the implementation of the recovery fund. I would expect this to be resolved eventually, but it's an unnecessary obstacle that Europe is adding to the issues we've been facing on the vaccination campaign. So in all, I would say the second half of this year still looks very good for the euro area, a bit less than in the UK. But for the longer term outlook to come closer to what we expect now in the US and reach pre-crisis trends, not only levels of activity, then yes, I think we need more stimulus.
I want to get your take on the U.S. rate situation, Frederick, since we have you. We have a couple of auctions coming out today, and as Kayleigh mentioned at the top of the show, big focus on the inflation numbers tomorrow. They could be a jump, obviously, from a low base. The comparison maybe isn't terribly fair. Nonetheless, will it move markets?
Obviously, we've seen the sensitivity of markets to PPI releases last week, producer prices indices, which is usually a non-event in markets to a large extent. So we will definitely focus very much on the details, perhaps not the headline CPI numbers, which will skyrocket in the next few months, but the core underlying measures in the US to see to which extent the reopening of the economy leads to a spike in prices. Even so, I would say, I still believe that the market believes the Fed reaction function to a large extent, in the sense that this spike is expected to be temporary. Right. The increase in inflation expectations that we've seen is not that sharp. It's manageable for the Fed so far.
All right, we have to leave it there. Thank you so much for joining us today. Frederick Ducreuset, Global Strategist at Pictet Wealth Management. And coming up later this morning, an exclusive interview with William Dudley, former New York Fed President. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day. This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Breaking news out of Germany. The CDU is backing Armin Laschet as its chancellor candidate. Now, as our editor-in-chief emeritus, Matt Winkler, always says, news has to be a surprise. This isn't a surprise. Still important because he's going to face off against Markus Söder, likely against Markus Söder from the sister CSU party out of Bavaria. But, Kaylee, in terms of gigantic national news, I don't think this is as big as Hideki Matsuyama winning the Masters yesterday.
Yeah, I think people are probably a little bit more excited in Japan today. The first Japanese person to ever win a major golf tournament. It was really exciting to watch over the weekend, and especially when he put on that green jacket. It was quite a moment, and you know that a lot of Japanese are celebrating this victory today, Matt.
Yeah, absolutely. I can't wait till Suga comes to the White House on Friday. Biden will certainly congratulate him on winning what I consider to be the greatest sporting event in the world. Coming up, Klaus Regling from the European Stability Mechanism. This is Bloomberg.
markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Matt Miller in Berlin. Francine Lacqua is out at the pub today because the UK is reopening. Matt, we're following news there. We're also following news in Germany. The CDU officially backing Laschet. Now we're awaiting what the CSU is going to do.
Yeah, absolutely. I'd say I'd rather be at the pub. I was looking for reservations at the Ivy, found nothing. At Annabelle's, no tables left. Soho House completely booked out. So I don't know where I would go if I were in the UK. You got to be in a place that has outdoor space, right? Here in Germany, there was really nowhere else to go for the CDU except for Armin Laschet. They have kind of backed themselves into a corner in a sense. He's their candidate, like it or not. Their sister party down in Bavaria, the CSU, has a far more popular candidate in Markus Söder. The question is, will the CSU back him? We'll find out in a couple of hours. And then tomorrow, if they do, there's going to be a head-to-head in the Bundestag. The caucus will decide who gets to ultimately represent the CDU-CSU bloc. Typically, it's the much bigger CDU candidate, but Franz Josef Strauss famously represented the bloc out of Bavaria decades ago, and a lot of people will be talking about Strauss if Söder gets the win.
Yep,
Kaylee?
so we'll be tracking all of those developments as they come. But first, I want to get a quick check on the markets because after record highs reached in the U.S. to end last week, it is a risk-off tone today. It really started with risk-off in the Asian session. European stocks following Asian stocks lower. We're down about 0.25% on the stock 600 at this point. So not a huge move, but still, it is definitely a down day. And S&P 500, of course, crossed that 4,100 threshold on Friday. Today, E-mini futures off by 7 points. We're not getting a lot of movement, though, in the bond market. The 10-year Treasury yield is literally flat. We're sitting at 1.65% ahead of $38 billion in supply coming online at 1 p.m. Eastern time. So we'll be watching to see what the takedown of that is. And I wanted to note Bitcoin as well. Right around its all-time high, just about $1,000 or so shy of it. It is above $60,000 once again. So a lot of eyes now on the crypto space. But what else is new? I'm always watching Bitcoin. As for some movers in pre-market trading, there were a couple outsides that I did want to note. Nuance Communications surging almost 20% before the bell. Microsoft apparently set to buy the company for around $56 a share. Right now, it's just about $2 shy of that in early trading. Marathon Patent Digital Holdings, of course, is a stock tied to cryptocurrency with Bitcoin above 60,000. That is aiding the stock. It's up about 8% in pre-market trading. I did want to note Alibaba as well. It was one of the outperformers in the Asian session after a $2.8 billion fine from China, but it removed some of that regulatory overhang, and the ADRs here in the U.S. up 6%. In pre-market trading. Also up 6% is CureVac. On Friday, a German newspaper reporting the company expects it to get EU approval for its COVID vaccine by May. So that is lifting sentiment. Those shares up around 6% before the bell, Matt.
I got to tell you, there was a time, I covered Bitcoin from the very early stages, and there was a time when it fell down to 250, even less. Joe Weisenthal said, hey, you're going to back up the truck, and I thought it would be journalistically unethical for me to buy a ton of this asset and then continue to cover it. But had I known it was going to go to 60,000, I may have made a different decision, Kaylee. Take a look at this chart that I have before I get myself in trouble. For our listeners on radio, this shows, once again, debt to GDP. And the numbers are huge if you look at a lot of European countries. Dan Curtis rearranged this to show the big economies in Europe. Italy, 154% debt to GDP. France and Spain, 115% debt to GDP. But the Netherlands and Germany have a lot of room to maneuver. 70% for Germany, 55% to the Netherlands. They could borrow a ton more and still would be fine. And that's what I want to talk about right now with Klaus Regling. He joins us from the European Stability Mechanism to talk about a number of issues. But one of the questions, Klaus, that we've been hearing today from investors is, when is Europe going to come out with more fiscal stimulus? It's really necessary. Do you agree?
No. And let me say that governments and international European institutions, and they all met in Washington last week at the IMF spring meeting in a virtual way. There were no such demands. They come from some people in the markets, only some, and from some journalists. Because when you look at what Europe has been doing, it's very, very impressive. And that was recognized by the IMF. The IMF revised up the growth numbers for Europe for this year, for instance, in its most recent World Economic Outlook. So there was a lot of praise for what Europe has been doing. Some like to compare the numbers Europe, US, but they are comparing apples and pears, I think, because the fiscal deficit, that's true, is jumping up a lot more in the US, which, by the way, also means that the debt levels in the US are higher than in almost all European countries now. But what is not taken into account is that...
Well, also the U.S. moves a lot faster, Klaus. Right? The U.S. moves a heck of a lot faster. I mean, we just passed last month $1.9 trillion in stimulus. $1.2 trillion will be spent by September. Now, the EU...
That's only part of the story.
I'm listening.
I was going to tell you what's the other part of the story. The U.S. started in 2019, before the pandemic, already with a huge deficit. So they had to jump to much higher levels than Europe in order to have the same kind of fiscal stimulus. And in addition, what Europe is doing a lot more than the US is public government guarantees for bank lending, for instance, for corporates. That is in Europe. Last year, it was 17% of GDP. The US was only 7.5% of GDP. This does not show up in deficit numbers, but it can over time, and it does stimulate bank lending and economic activity. So one should be very careful comparing these numbers. And on top of that, you know, there are very serious economists in the US who think the US government is doing too much.
Yes, absolutely. And you're 100% right about the bank guarantees. The loan program seems a lot stronger. There are still questions from serious economists, from market participants and journalists alike about the sloth of the European Union in terms of moving on this $750 billion recovery package. I mean, it's not even expected to spend a dime until this summer. And then, if my reporting is correct, only 13% of the package. That all is at peril because of the German constitutional challenge to this. Why can't the EU move faster when necessary?
People like you like to complaining about the slow movements in Europe, but we are not the United States of Europe. We are in the Euro area 19 and in the EU 27 sovereign states, so they take a bit more time. The 750 billion euro package that you mentioned, which indeed is a key response from Europe to the pandemic, it is on time. There was never an expectation that money would flow before mid-2021. So nothing to complain about. From an economic perspective, it would have been better for it to flow earlier, that's true. But we knew that that would not be possible because it has to be ratified in 26 parliaments. But it is very important the way it's set up, because unlike the US stimulus so far, which is all geared to strengthening demand, what we are doing in Europe, we strengthen with this package, 750 billion, the supply side of the economy. So the long-term effect will be much more positive than what I see elsewhere.
So you don't fear that if there is a delay, like in Germany that Matt speaks about, that it's going to hit the economy too late and therefore not have the desired effect?
Well, it was never designed to stimulate demand like what you see in the US. That was not the character of this package, but it has the advantage that it will strengthen the growth potential, and that you don't reach when you just strengthen domestic demand by sending checks to all households. There's this new element that we don't know when the German Constitutional Court will act. That is an uncertainty, absolutely, and that's new. The experience that I have had personally from the ESM 10 years ago was that also then the German Constitutional Court stopped the process for a few months, and then they formulated a few conditions which had to be met, and there had to be clarifications on particular what are the overall obligations for the German budget. And I wouldn't be surprised if we see something similar. It did not stop the ESM from playing its role 10 years ago, and that would still be in line with the timing that was envisaged for the next generation EU.
Klaus, you mentioned the difference in debt levels between European countries and here in the U.S., where I'm speaking to you from. Are there debt levels anywhere that are concerning to you? And do you think there should be a return to the debt and deficit rules in the EU, or that those rules should be revised?
This is a difficult question, and one that economists think a lot about these days, because on the one hand, interest rates are probably permanently lower than what we used to have 10, 20, 30 years ago. They can go up, and I expect them to go up from the current level, but they will probably not on average return to where they were 20, 30 years ago. And that means the debt carrying capacity of governments is higher today than what we thought a few decades ago. So in that sense, to have higher debt levels is not concerning. However, there are, of course, limits. And we see that also in other countries around the world that don't have reserve currencies that can be created easily. Their debt levels can reach risky areas much faster. So there will be limits. And this is, it's not clear where they are exactly. So on the one hand, yes, higher debt levels are okay, but they have been jumping a lot. And this needs to be controlled over the next few years.
In terms of reserve currencies, Klaus, at one of the last ECOFIN meetings, the ESM raised the importance of the renminbi in the changing global system. It's gaining importance versus other currencies like the euro. What does this mean for the euro?
Well, I would look at it in the overall context. Where is the world monetary system moving to? We know the last 70 years there was one dominant currency and not much else. Then since 1999, we have the euro, which since its creation has been clearly the number 2 in the international monetary system. And I think the renminbi, coming from a much lower level, is trying very hard to catch up. The Chinese government wants to strengthen the international role of the renminbi. So I see the world economy moving towards a more multipolar system with, at the moment, 3 currencies. There may be others in the long term if countries like Brazil have better economic developments. But at the moment, there would be 3. Of course, with a clear leading currency, still the euro, still the US dollar. From the euro, we never tried to replace the dollar, but to have a system with more equal currencies, I think would be good for the world economy, because we saw in the 80s in Latin America, in the 90s in Asia, that reliance on only one currency can lead to problems. And that's why we had was one major reason for the Latin American debt crisis and the Asian crisis in the late 90s. So I think for the system as a whole, this is a healthy development. And it will be very interesting to watch not only how the euro will be doing, but also how the Chinese currency, given the weight of the Chinese economy and the clear policy in China to push the role of the renminbi.
Yep, interesting indeed. Klaus Regling, European Stability Mechanism Managing Director. We have to leave it there, but thank you so much for joining us today. And coming up, the White House is hosting a summit on the semiconductor shortage as Democrats prepare to tackle Biden's spending package. We'll have more on U.S. politics next. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
COVID caused everybody to step back a bit from capacity and build out and the supply chain of the industry, and it induced a radical increase in demand.
Obviously, the last year has been very, very difficult to deal with. Nobody knew which direction demand was going to go in.
There's not a single industry that not been impacted by the semiconductor shortage, from automotive to IoT to home.
It's a serious topic. The whole industry is affected. The capacity is too low. For all players like automotive industry and consumer electronics.
Industry which was even increasing last year in demand, in particular in the second quarter with all the lockdowns which happened on home office supplies. That's where the automotive industry was in a standstill. And that's where, since then, the automotive industry is in a catch-up mode.
Of course, we're working every single day with a cross-functional team to look for opportunities of how do we minimize the impact. So we'll continue to do that. And so it's a year of execution. And, you know, the issues with chips, this is a short-term issue, and we'll work through it.
It's going to be chaotic and challenging, but I think we can navigate through it, still being able to hit our retail targets for this year.
Industry leaders discussing the global chip shortage, and later today, the Biden administration's top national security and economic advisors meet with more than a dozen chief executive officers to discuss the shortage. Joining us now is Marty Schenker, Bloomberg News editor-at-large. Marty, what can the administration do to help ease this problem?
Well, it's very unclear at this point, Kaylee. There really isn't much they can do because this is an issue of production that's just not happening. And there's really very little that we expect to come out of this except to let these companies air their grievances. But other than that, there's no concrete plan expected to come out of this meeting.
Well, we know that Congress is looking at this too. Majority Leader in the Senate, Chuck Schumer, has proposed spending to shore up U.S. semiconductor manufacturing. And a lot of this issue is being framed as we have to be competitive with China. And that's the same argument that's being made that President Biden is attempting to make with his infrastructure package. Does that make it easier for Republicans to get behind that kind of spending?
Well, Republicans have too expressed concern over the supply chain issues and China's role in semiconductor production. But really, when you come down to it, it takes at least 2 years for a chip plant to be built. So there's no short-term fix for this. There's going to have to be an allocation, and it may be that the market determines this rather than government policy.
You know, I've gotten some messages over the past 24 hours from market participants, Marty, who are worried about geopolitical hotspots in eastern Ukraine on the border with Crimea. Things are starting to get a little heavy again in terms of China and Taiwan. You're starting to see jet fighters running over the straits there, and it could be escalating. Are we at a point when the markets are going to start showing concern?
Well, you do have to wonder at what point does the market start to take geopolitical issues into their investment calculations. Tony Blinken, the Secretary of State, issued a pretty stern warning to the Chinese over Taiwan. And as you know, Taiwan is a real touchstone issue for the Chinese. So at this point, I don't think the markets are expecting any real crisis. But complacency is dangerous in any investment environment. So you're right, it could start to rear its ugly head in any number of places.
I wanted to ask you about one more U.S. political issue. You know, we just had the Masters, which was fantastic.
Yeah.
But in Georgia, in Georgia, the voting rights issue has been a huge one, not just for political leaders and citizens, but also for corporate citizens, if you will. And there's been a lot of push and pull. Delta got into it with the state Senate. Mitch McConnell said he doesn't think that corporations get involved in politics anymore, though he'll still take their money. What's this look like to markets? Because it's a growing problem.
It is a stark change. Look, when I started covering business news 40 years ago, it was just a tenet that companies did not get involved in controversial issues. And now it seems like they're confronting them every day. And there was a conference call on Zoom over the weekend of executives pushing them to, and some agreement on how they should push for voting rights. Now, the Republicans say that the Georgia voting rights legislation actually gives more access. But that's not what Democrats and what activists are saying is happening there and in other places. So companies are going to have to confront this, not just for their customers, but for their employees. So it is an inflection point of sorts for corporate America.
Absolutely. All right, Marty Schenker, Bloomberg News editor-at-large, thank you so much. And coming up later this morning, we'll have an exclusive interview with William Dudley. He's the former New York Fed president. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines in New York with Matt Miller in Berlin. Francine Lacqua is off today. And now joining us, Tom Keene, co-anchor of Bloomberg Surveillance. And Tom, can we just fast forward to 8:30 a.m. tomorrow when we get the CPI print here in the U.S.?
Well, we're going to get the CPI print, but one of the big stories of the week as well. I would double barrel it is CPI, Kaylee. What's inflation doing? All the issues of cost pressures, and that's going to go right into what we see from corporations. Earnings season this time around is going to be absolutely original, and of course the dovetail of that is to the great American economics. Kaylee, this morning, Jacob Frankel will join us for the Group of 30. His years of work with J.P. Morgan. We're thrilled to have Dr. Frankel with us. William Dudley will be with us as we continue a series of really wonderful interviews on the economics of the moment. And from Asia, really looking forward to this. Gina Auric will join us on China and, of course, the sensitivities across the Taiwan Strait.
Yeah, we're definitely watching China. Tom Keene, co-anchor Bloomberg Surveillance. Thank you so much. And Matt, we are also watching Germany today, aren't we?
Yeah, I'm definitely keeping an eye on what comes out of the CSU. It's a little bit in the weeds, but the ruling parties in Germany, one of them, the CDU, is broken up into two. It kind of has a sister party, and they may elect a challenger to the CDU's Armin Laschet.
Yep. All right. Coming up in the last hour, Brian Weinstein, Morgan Stanley Investment Management, head of global fixed income, will be joining Tom, John, and Lisa. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
we want our policy to be robust if our models break down.
In the second half of the year, I think you're going to see things really start to ramp up. So, they're going to find themselves sort of behind the curve.
There'll be numerous tests of the Fed that the Fed will have to reply to over time.
There's kind of still this catch-up that's happening in correcting for the COVID shock.
We are to some extent flying blind here. This pandemic is quite different than the